the last podcast of this week, and oil prices continuing their downward slide. We're trading this morning below $85 on Brent. Has been the sentiment for some time. We saw it in August, the weakness, if you like, in the oil markets, and then it took Saudi Arabia's intervention, sort of jawboning things back up to the mid to high 90s, and then with the announcement of OPEC Plus in early October to cut quotas by 2 million barrels a day from early November. And now a month later, or not quite a month later, since the OPEC cut went into effect a few weeks, oil prices again drifting down. Let's kick off this morning with Andrew Lavin, COO of Sahara Energy Resources. Andy, do you think is the catalyst here? China not opening? Where do you see the weakness in this market?
I think the weakness is demand, as you kind of laid out. And we saw that overnight with the gasoline stocks in the US having a build when we would have expected a draw. So I think, with inflation, prices going up, I know the winter's coming, but if you look at the UK, everybody's concerned about how they're going to pay for their heating bills. They're investing in blankets rather than heating. So I think the weakness is definitely on the demand side.
The other situation, of course, is what will OPEC Plus do about this? Let's go to Jamie Ingram, senior editor of the Middle East Economics Survey. Jamie, OPEC Plus in a bit of a quandary here. Do they shoot their next bullet before the first one has had a chance to impact?
Hi, Sean. Yeah, great to be here. As you say, a bit of a quandary heading into that 4th of December meeting in Vienna that everybody's so excited about. It was interesting that we saw, I think, a bit of a trial balloon going up earlier this week with the Wall Street Journal story. That kind of went down with a bit of a lead balloon, quite frankly.
It was a bit weird. We're going to raise
absolutely.
The market's contrarian.
The market's softening, and they're talking about potentially boosting production. That, as I say, went down like a bit of a lead balloon. So I think that's basically taken that off the table. But they wanted to see what the price impact would be of that kind of speculation. Brent lost $4. We got very firm and fast response from the Saudi minister, followed up by allies across the GCC, Iraq, and Algeria. So I think production increases, I think we can fairly safely say, are off the table. Will they start to add to that 2 million barrel a day quota cut? That's the big question at the moment. That it looks as if they're leaning towards towing the line, but realistically, it's the coming week that's really going to set the scene for that. For that meeting, we're going to start to see more of a dialogue, more of these kind of leaks start to come out, and we're going to see if OPEC Plus firm up their the direction in which they're looking to travel across for that 4th December meeting. But it looks as if they're probably set to toe the line, see what the impact of this 5th of December EU embargo on Russia oil and the G7 price cap that looks like it's set to come in then as well.
Let's go to Daniel Ramat, Senior Energy Security Consultant based in Tehran. Daniel, first and foremost, as much as you can share with us, how challenging a time is this in Iran at the moment with the social unrest seemingly, with full flow?
Hi, Sean, and congrats for a very successful conference in Oman.
Thank you.
Actually, the Iranian establishment is facing several types of challenges right now. One of them is the protest. As you said, this was a sort of unprecedented protests here in Iran. It's not comparable with the previous ones in terms of the scale, in terms of the length and the time of these protests, and actually the geographic distribution. Every province of Iran is now engaged in those protests, and seemingly the Iranian establishment has somehow failed to control that. And despite the propaganda Iranian regime is broadcasting through its government-controlled media, Iranians are not now divided, and ethnicities are now somehow following a sort of unity. Anyway, I think this is the main challenge to the Iranian government at the moment. But market-wise, if you compare the news which have happened about the which were broadcasted about the JCPOA and the potential failure of that deal, market is more sensitive about that. And the bad news for Iran at the moment is the horizon for JCPOA is getting darker and darker. And that's
darker
the second
mean
point.
it's dead, or
it really depends on Iran. It really depends on Iran. If Iran really wants the deal, if Iran starts to forget about the demands they have already made, the extra demands Iran has already made, if they forget about them, the chance for coming back to the JCPOA is not dead yet. But the protests, actually, the social pressure in the Western governments regarding the brutal crackdown of the Iranian protests here is another important fact. Democracies cannot close their eyes on the brutal crackdown in the Straits of Tehran. So this is another element which has entered the JCPOA actually deal. And the third one is very, very high rates of inflation in Iran. According to a study I recently made, the prices since October 2020 increased something about 300% in Iran, but the U.S. exchange rate increased just 27%. That means a very huge burden on the Iranian government for controlling the exchange rate, while they have not succeeded to control the inflation. That's a very huge burden. The hard money, the hard currency they're earning from oil exports and petrochemical exports and blah blah, they're losing easily in the domestic market for controlling the exchange rate. That means that money is not working in the favor of the government just for controlling the exchange rate, while they're losing to control the inflation. And if you look at the OPEC statistics, Iran has also failed to increase its oil production while the demand in China was increasing. That does not mean that Iran is not able to market its products in China. It means that Iran has significant technical problems for increasing the production, the crude production. So anyway, I think Iranian oil production at the moment, with something about 1.1, maximum 1.2, is going to be limited unless remarkable investment would be flown inside the Iranian oil industry, which takes time. So I believe Iran is facing serious challenges.
Andy, meanwhile, back at the ranch, so to speak, if one looks to the financial markets, the equity markets as the kind of forward-looking guide to the world, it seems like we've a party coming in the next 6 months. Equity markets are nearly back to a bull run. There's general optimism that this sort of rate rises have now peaked, and it's sort of back to the punch bowl.
Well, I think the problem is that, especially if you look at the US, which is really predominantly what you're talking about there, is that.
But even in Asia today, it's a big, the market's rising everywhere.
But they're very much driven by the sentiment in the US, right? So if you look at the US, I mean, that you've got this bizarre situation where they've got an exceptionally strong jobs market. Yet all the economic indicators are saying inflation's going up, problems coming. So I think underneath it all, my personal opinion is you've got a very complicated situation, which actually goes back to all the money that has been pumped into the economy has had an impact and will have an impact. And it's probably creating a much stronger kind of undercurrent of positivity that actually you'd expect from the inflation and the interest rates. So my expectation is, as we were seeing in the news recently, is there is the expectation that the Fed is going to start kind of pulling back on its pace and size of their interest rates. That has to give the confidence that the.
But they're still going up, right? They're still going up. 50 basis points is still a big number.
Yeah, but what's the total at the moment? I mean, I'm sorry. I go back to when my first mortgage was 14%, right? 6% mortgages, fixed rate for 5 years in the UK. Hey, that's cheap in my experience, right? But maybe I'm getting too old. So
but it's kind of all things relative of what's the starting point. I mean, if you borrowed £1 million because you're kind of suburban mansion was elevated beyond nonsense, and now you've got a mortgage rate that's 6%, that's going to be quite serious.
Correct. But underlining, so there are going to be individuals, groups that have taken maybe the wrong step, taken too much advantage of low inflation rates, they're going to be hit. But the underlying kind of essence of the amount of free capital there is, that's going to have somewhere to go. And as soon as the economy is seen to have the slightest hint that actually everything is going to be okay, then there is going to be a party.
Well, it feels perhaps like if Jay Powell wants to keep his grip on this market, I think he's going to have to think a little more shock and awe. Jamie, what is the situation in Europe? It seems we've gone from, although I saw some pictures of friends on LinkedIn over the last few days wearing triple coats in their houses. I'm not sure if it was half joke, but half certainly real. But nonetheless, the stress of Europe avoiding the worst case scenario, and then overnight, the devastation across Ukraine, numerous nuclear power plants shut down. This is a very serious situation.
Oh, it's extraordinarily serious, Sean. Yeah, absolutely. Worst case scenario, yeah, it looks as if gas stocks they have been filled up faster and sustained higher for longer than expected because of a mild start to the winter over here. But still, prices are extremely high. The impact on people's earning power, the amount of money in their pocket is extraordinary. So that's going to slow down the economy. But yeah, the near-term outlook is good, but I think that people have been underestimating for too long the long-term outlook. Everybody, frankly, the politicians, as much as anybody else, have been talking about, oh, this winter. Now we're starting to be talking about what about the following winter? This is something that's going to hit hard in 2023. Frankly, it's going to hit hard in the winter of 2024 as well. When you look at, Europe increasingly turning to LNG imports, the Germans finishing construction of their first ever LNG import facility that's going to start up before the end of the year. Okay, great, but nobody's brought any more LNG onto the market essentially. So that's just buying from exactly the same pool as was there before. Looking out into next year, who's bringing on the supply as well? Okay, so we'll have some repaired plants coming on in the US, but that's about it. Then 2024, we've got Qatar and ExxonMobil bringing on this Golden Pass facility in the US. That's really the next big facility that's going to come online up until the North Field East expansion in Qatar, and that's where Europe is looking to replace these Russian volumes. I'm sure people talk about North Africa. Volumes of pipe gas from there are incremental. There's increasing demand in the likes of Algeria and Egypt. And frankly, the supply side isn't that great. It's more about replacing natural decline than anything else. Azerbaijan, sure, maybe some more volumes coming online there, but it's not going to be, it's LNG that is going to be required to replace those Russian volumes, and that's not coming online in any big volumes anytime soon.
What about the outlook for LNG with all of the floating storage off the coast of Europe, floating tankers waiting to offload? Is that being processed? What's the outlook for that, Jamie?
Yeah, I mean, I think we're just holding it at the moment, basically. Storage facilities in Europe aren't massive, so those are going to start emptying. Then we'll start seeing those floating LNG tankers that have been stranded, marooned off the coast of European buyers start to come into port and be unloaded effectively. I don't. Some of them might be rediverted over to Asia as buying it there starts to pick up again, but I suspect most of it's just going to slowly get drawn down in Europe.
Daniel, where does this situation, do you think, leave Iran in its current? Obviously, the idea that it could choose now to even re-enter the JCPOA looks like it is a choice out of even their hands, given the predicament that it would leave many other countries, given what's happening in Iran. But the big news that happened this week that sort of went by unnoticed, although I think a major development, was the announcement of 60% uranium enrichment in certain facilities in Iran. This is a fairly substantial progress towards the capability of sufficient uranium for a weapon. Where does that stand, do you think? What's the consequence of this progression towards an inevitable destination?
Frankly speaking, I think Iranian establishment, when is under pressure, is not going to step backward. their strategy is just getting more aggressive and becoming more straightforward, focusing on the more enrichment levels. And also remember that IRGC's space program has developed significantly. They recently tested a satellite carrier, which even according to the media affiliated to IRGC could be easily converted into a sort of very long range, actually, missile, which with capabilities of carrying heavy actually warheads or something like that. So I think the IRGC's approach towards the Kurdistan, Iraqi Kurdistan, bombing the actually military groups, actually armed militias there, and also threatening the local government of Kurdistan is somehow following the same policy, targeting the tanker up the coast of Oman, and such behaviors would reflect the strategy that Iran is taking. Actually, Iran's military capabilities has increased significantly during the last years, especially in terms of the kamikaze drones and types of that weapons. So I think Iran is gonna, if the European countries, if the West, and of course the United States, if their policies are going to, if the policies is to more restrict Iran, is to block Iran's way for reaching the deal, Iran is going to become more aggressive. This is based on my understanding. So I think Iran is going to push more for the deal, but not in terms of, let's say, something like begging. They're going to push them for more. Actually, they're going to use their leverages as much as they can. So at the moment, the problem between Iran and Saudi Arabia, since the negotiations between Iran and Saudis in Baghdad is now freeze somehow, and let's say has failed, and Iran is blaming Saudi Arabian affiliated Persian-speaking actually television channels in London, elsewhere, for actually encouraging people for coming to the streets. This could somehow make some troubles for Saudi Arabia too, because we need to consider that the Houthis in Yemen are somehow proxies of Iran, and they would easily target the oil infrastructure of Saudi Arabia. But there is another
which has happened before.
Of course, it's happened before, and they also showed something. There was a drone trying to attack a tanker off the coast of Hadramaut province in Yemen to show that we are still capable for carrying such attacks. And there is another very important factor here, which is the Russians in the north. Actually, they have a very huge amount of gas. They're trying to use Iran as a sort of corridor to get their gas to Pakistan, India, probably exporting gas to Turkey. And recently there was an agreement, there was a contract between Azerbaijan and Russia for importing gas from Russia. This means that they're going to use the Russian gas in their domestic market so they can export more gas to Europe. The same story is in Iran. They're planning to import Russian gas, and instead they can export much more gas to Turkey, and then Turkey can export that to the European Union. It is very ridiculous. At the end of the day, that means Europe is still importing the Russian gas, but with more costs. Anyway, but to me, this means that Iran, as a sort of middle country, which can connect Iran, the Russian gas to Europe, also the Russian electricity to Iraq and the Middle Eastern market, is now very much more important for Russians. So that the role of Russians in the JCPOA deal is more, and
it's got kind of sucked into the vortex of the Russian geopolitics. Let's go to the survey question and get everybody to view so we can have a chance to post on social. What will have greatest impact on direction of travel for oil prices into the end of the year? The EU oil embargo on Russia from December 5th. China COVID lockdown continues. OPEC Plus make deeper supply cuts on December 4th. What will have the greatest impact on the direction of travel for oil prices into the end of the year? Andy, as we sort of emerge into this final sort of stretch to the end of the year, we're reminded as you articulated in your earlier comment, of the building inventories in the US, but also the story overnight, which seems to be inching towards Chevron and US oil industry re-engaging in Venezuela. We're reminded of how many, and just hearing Daniel talk about Iran, these major oil reservoirs left untapped in this current cycle, perhaps the source of a lot of new supply.
No, I think that's absolutely right. I think the kind of the Western world has almost forgotten historically the impact of geopolitics on economics, and that was really how Europe got into trouble in terms of being able to turn the taps off against Russia. In a global kind of economy, you want to be able to get it from the cheapest place possible. And in that world, it's easy to say Venezuela doesn't matter. Iran will use that against them. But actually, if you want to have diversity means diversity. It means being able to get product from lots of different locations. And I think what we're going to see over the next few years is politicians having to not eat their words, but be more inclusive or more understanding of different situations in order to bring that diversity. And I think that's what you're seeing in Venezuela. They've got an enormous amount of oil. It's not easy oil. It's not particularly nice oil to process, but it's oil and it's easily got out of the ground. So that's a classic example where, be careful what you say yesterday, because tomorrow you might need to be friends with people.
We all need to follow that motto, I think. Jamie, your thoughts on where this leaves OPEC Plus going into the final meeting of the year? A lot of tea leaves to read. Ultimately, can they defend $90 a barrel floor through the first quarter? Do you expect that to be their North Star?
Yeah, I think that's interesting that you point to the first quarter, Sean. I mean, we're not talking about what's going to happen for the remainder of the year anymore. But yeah, just in terms of ending the year, I suspect that prices may well soften a little bit further. But then, as we start to see, I think China effectively is going to, in answer to your poll, I think China is going to be the big variable here. If China opens up, then even just incrementally, then yeah, we're going to see stronger demand. We're coming out of the weekend to the year where even the IEA says that we're actually going to see demand fall year on year over the quarter, which outside of COVID is obviously a very almost an unprecedented development in recent times. But then yeah, coming into 2023, I think that the demand picture will improve somewhat despite global recession, etc. And yeah, it's just, if OPEC sticks to the path that they're on at the moment, $90 is defendable.
I mean, it doesn't look like the market's too convinced by the announcement of the 2 million barrel a day quota reduction at the last meeting. The tangibleness of another cut, if they wanted to, would it have impact? Why do you think the market is not reacting? They don't believe the volumes, or what? Where do you think the credibility issue is?
I think at the moment they just don't believe that OPEC Plus is going to remove significant volumes from the table effectively. Some of the numbers that have been thrown around is a 500,000 barrel a day quota cut. I don't think that would be quite on the same ratio as the 2 million barrels a day in terms of translating quota into reality, just because that would start to potentially drag in a couple of the other producers that weren't affected by this latest cut. But still 500 would maybe translate into 300,000 barrels a day. But of course, the big variable on the supply side is what's going to happen with Russia. We're going to have this EU embargo come in on the 5th of December for loadings. Then you can continue. I think
the oil price cap, which is about to be announced any minute now.
The oil price cap, but that's effectively just I think the US got spooked by the firm line that Europe was taking. Frankly, this is an attempt to undermine the impact of that, the European embargo, just to enable some volumes to continue flowing. It's probably going to achieve that, especially if it comes in at an oil price cap of 60 to 70, which is effectively what Russia's selling it at the moment. But it's made an almighty ruckus. That certainly did not go down well in OPEC Plus cap source because they do not like the idea of prices being dictated to them by buyers. Sorry.
Well, it's also somewhat guided, I think, by the fact that Biden made an announcement, a month or a few weeks ago, where he set a floor of 70, was it, on WTI to replenish the SPR. It sort of indicated that, the prices could fall below that, but we're going to buy it at more expensive. It was sort of like this thing could all turn up a bit weird. Let's get this survey result and give the last word to Daniel this morning. OPEC deeper cuts could still direct travel here. I'm on China myself. I agree with Jamie on that. Daniel, I wanted to get your thoughts. I know you do some advising and consulting around Korea, the Korean oil sector and its sort of supply from the Middle East. Where does that look like at the moment, the Korean view, the Asian view beyond China and India, the discounted Russian oil? Do the likes of Korea, obviously a strong US ally, unlikely to participate in that?
The Koreans actually energy supply policy in terms of the oil story and the LNG story is absolutely very, very different in terms of oil. The LNG, when Koreans and Japanese started to invest a lot for long-term off-taking contracts with Qatar and elsewhere, they were not just thinking about the price or actually the economics of that agreement. That was all about the energy security and the economic resiliency of the country, because 100% of the natural gas used in Korea is imported through LNG, because Korea is somehow by some means landlocked. Actually, it's sort of island limited in the north with North Korea, and the rest of the country is sort of peninsula, also circled by water. So in terms of LNG, the policy when was in the initial phases was not based on the econometrics. It was based on the energy security and the resiliency of the country. But when it comes to the oil, the story is very different. Once Korea was the major oil importer, the number one oil importer of Iran in the East Asia, and Iran was the major supplier of oil and gas condensates to Korea. We need to consider that Korea is also a very major gas condensate importer because of the structure of the country's petrochemical plants and refineries. So they were challenged by somehow the most challenged country after Iran, after the Iranian sanctions, after the Trump's administration sanctions in Iran. Korea was challenged the most. So maybe you have heard about the Iranian blocked assets in Korea. That's because of the huge amount of oil trades between Iran and Korea. So after that, Korea had to decide to import its oil and gas condensates from more diverse countries. In terms of gas condensates, they approached toward the United States and Australia. So now at the moment, Koreans have no specific problem with their gas condensates, but they'll be very eager to import gas condensates from Iran again if sanctions are lifted. Please consider Korea is not like China. They're not going to import Iranian oil by any means. So if sanctions are not lifted. But in terms of oil, they're thinking of actually better types of contracts, better types of cooperation with the GCC countries. And I think they're going to succeed because recently the type of the Korean market in the Middle East and elsewhere has changed. Poland, as long as I've heard, has become a sort of military equipment importer from Korea. Also, the GCC countries are interested in more advanced technologies imported from Korea, and in return, maybe they can reach to sort of long-term deals for securing Korean energy supply. Korea is very different with China, United States, and some European countries. Korea has to enter win-win deals, and there is no strategic influence over those countries. So I think Korea is going to enter sort of a new generation of contracts and agreements with GCC countries for securing its oil supply.
They certainly have a lot of very unique bespoke technology to offer in that win-win equation. We're going to have to wrap it up there with Brent crude oil trading at 84.83 a barrel. Be very interesting to see where it's at when we come back next week, as we sort of drift to the end of this holiday weekend in the United States with Thanksgiving today. But clearly, there is a structural weakness entering this oil market, and I'm not sure there's any sort of cut. Well, of course, there's obviously some size of cut OPEC Plus could announce, but ultimately the credibility of the OPEC cuts are not scaring this market. The threat of a sanctions on Russian embargo on Russian oil is not sort of threatening or scaring this market into a energy security upward motion on oil price. It seems that the market's swallowing a lot of these sort of announcements and emerging realities, and the structural weakness, the demand destruction perhaps is what's locked in the heaviest. We'll have to wait and see. But for now, I'd like to thank you very much, Andrew Lavin, for joining us today. Jamie Ingram and Daniel Rahmat, really appreciate your insights and your participation this Thursday, the final session of the week. We'll be back on Sunday, 10:30 UAE time. All the best. Thank you.
Thank you very much, Sean.
Thanks, Sean.